Hello everyone, welcome to our Egyptian online seminar group. First, compose of any of any questions you can ask our speaker during his presentation or after his presentation. I have a great pleasure of welcoming the Professor Christopher Yust. Christopher Yust is an associate professor in accounting at the Texas A&M University. His research focused on topics with real world to inform public policy in three interconnected areas, the intersection of law and accounting, accounting standard setting, and bank behavior and financial reporting. His research has been published in top ranking journals, including the Accounting Review of Accounting Studies, Contemporary Accounting Research, Journal of Banking and Finance, and the Journal of Corporate Finance. Now we will start our seminar with dear Professor Christopher. Yes.
Thank you. So I want to thank Mohamed for the opportunity to present today. Thank you to all the participants who've taken the time out of the busy schedules, since all of us always have more to do than we have time to do it, whether that's evening in Cairo or Asia, afternoon in Western Europe, or the morning in the Americas. I'm really looking forward to any questions or comments you have. Like Mohamed said, feel free to ask them at any point in my presentation. So the paper that I'll be presenting today is called "The Media's Role in Market Reactions to Securities Class Actions." It is co-authored with two of my longtime co-authors, Dane Donaldson at the University of Wisconsin-Madison and Antonis Kartapanis, also at Texas A&M. And this work really grew out of some of, frankly, our other projects on litigation and just our recognition of how complicated litigation filings can be, right? I mean, it's widely known and accepted that many times things written by lawyers are only understandable by lawyers. In fact, it's kind of so commonly accepted that it's often become kind of a joke. And so there was a well-known comic strip in the United States a few years ago, Dilbert, where Dilbert's boss comes to him with this legal contract and basically says, "Hey, will you review this?" And the whole point of the comic strip is that neither of them really have any idea what on earth the contract is talking about, and so ultimately his boss just concludes, "Well, I'll just sign it and see what happens." Now, admittedly, that comic strip was about a legal contract, which is a different area of law than that examined in our setting, which focuses on securities class action filings. But securities class action filings can be really difficult to read and wrap your head around too. There's lots of legalese, references to explicit codes of various sections of securities acts and other statutory laws that are alleged to have been broken. There are often random words in Latin and a lot of compound words. These things are just full of central embedded clauses, something that experimental research has shown makes things really difficult to understand, where you have these long sentences where they have these key terms that are kind of defined in the middle of the term. There are paragraphs that are, entire, pages of just like one sentence, and some are just really, really long. Some of these legal filings are as long as 100 pages, 150 pages. And so given kind of that complexity, we kind of thought that there's this seeming kind of contradiction, or at least a bit of a puzzle, in what we have observed in other papers, including some of our own projects, and what one would predict from another stream of research, which is that in the litigation research, we know that markets react really quickly and most impressively, really efficiently to litigation filings. So not only do you see large stock price drops on the day that companies are sued, but you see that the magnitude of that drop relates to the merits of the case, right? So if you actually kind of use kind of ex post revealed outcomes to kind of gauge the merits of the case, you look at ones that eventually settle, 3 to 5 years later versus ones that are dismissed, you see much larger negative returns on the day of the filing than the ones that are eventually dismissed. Similarly, other papers have shown that if there's a lot more indications of cultural problems or internal control problems or things like that in the filings, you get larger negative returns. And so not only does the market respond quickly, but it seems to respond pretty efficiently, pretty intelligently to kind of the merits of this and the potential impact of these lawsuits on future discounted cash flows for the corporation. And there's this recent paper in the Accounting Review by Carrizosa and Kazir that argue that litigation filings, they have a lot of really important information about the merits of the case, and so those could directly be kind of informing this market response. But at the same time, as I said, we know that litigation filings are written in really complex legalese, and there's a long line of research kind of in the market efficiency research that shows that investors are generally actually slow to incorporate kind of complex, low readability information, right? You see the markets are less efficient, there's more drift, things like that when you have these really more complex disclosures, harder to read, 10Ks, things like that. And so it kind of raised the question to us of, well, how does the market respond so efficiently to litigation when we know that the market often doesn't respond that efficiently to other things that frankly seem less complex? And so what we are trying to look at, the kind of what that we're looking at in this paper is, well, does media coverage affect that market reaction to litigation? And then if it does, why is that case? And so just big picture, I want to talk a little bit about the kind of what, how we do this, and then we'll kind of take a step back and go through a little more of the background and everything else. But what we ultimately do is we look at all securities class action filings from 1998 to 2019, so a really long period of time, and examine the market reactions really around the 61 days, so effectively the 2 months centered on the filing date. And there's two primary design features, and I'll come back to both of these when I talk through our design in more detail. But one, we try to examine how the effect of filing date media coverage affects that, both its existence and then the characteristics of the media coverage. And really importantly, we exploit the fact that there are often lags between when the filing actually happens, so when the company is sued, and when it's actually posted in what in the United States is called PACER, which stands for the Public Access to Court Electronic Records, which is basically when these filings are publicly available. Because of course, any kind of market reaction after the filing, but before it's really publicly available, seemingly can't be due to the filings themselves. And that also really tries to kind of allow us to better isolate the effect of the media. Because one of the big challenges in the media research, of which there's obviously a lot of really important papers, is that it's really difficult to try to disentangle what's the effect of the media and what's the effect of the underlying thing on which the media is reporting, right? Because kind of by definition, something has to happen for the media to report. And so if you see a reaction, it raises the question of, well, was that reaction due to the media coverage or due to the thing that actually happened? But this kind of allows us to kind of separate these things because there's a period by which the media may have kind of privileged information about the filing, but the filing can't be observed. And so otherwise, the market doesn't really know that it has happened. We supplement our tests with intraday returns, and then do a lot of numerous additional tests to try to explain why the media matters, right? And just big picture, what are the things that we ultimately find so we kind of know where we're going to be working toward in this presentation? We find that there is a significant market reaction, but it's basically limited to cases with media coverage. There's almost no market reaction to these things if the media doesn't report on it. We show that the market reacts within minutes to the first media article in our intraday test. And when we really try to disentangle more information on the why and looking at the characteristics of that media, we show that the nature of the article really matters. So press releases alone don't really do anything. You really need more substance that you find in like traditional articles or the combination. Of course, longer articles, articles that have more information in there, you get larger responses. And indeed, you find the largest reactions when there's more overlap between kind of the content in the article and the filing itself, which we kind of interpret as the media kind of reporting on what's in the filing, but in a more understandable way. We also, look at the question of, well, is this really about market efficiency, or could this be, it's the media is moving the market, but it really shouldn't be. But we find no evidence of a return reversal. And so ultimately, kind of our key takeaway is that the media coverage seems to reduce investors' integration processing costs, and I'll come back to talking a little more about what I mean by that. By ultimately creating more understandable litigation information, right? So with that kind of big picture set out, let's kind of take a step back and talk more about just the information environment and how is it that we do learn about these cases in the United States and how the media may matter and may not matter. We think there's a lot of tension there. So in the United States, securities litigation filings have long been public, but I put that word in quotes because they're public, but they weren't very accessible because originally they were accessible really only in person at the courthouse where they were filed. There are 94 district courts in the United States, and so the ability for anyone other than basically parties to the litigation itself to timely get this information there were a lot of frictions. And so given that, the federal judiciary came up with this idea for the PACER system to try to expand public access, right, and try to kind of increase transparency of the U.S. Litigation system. But in 1988, that was really more of just an idea as opposed to an execution. And so PACER's functionality was pretty limited until really the late 1990s from really a series of kind of three big things. So first, starting in 1996, the judiciary launched what was called the Case Management Electronic Case Filing System, commonly called the CMECF system, which kind of just utilized the wider availability of actually having electronic documents as opposed to just everything being in paper. Now, while that launched in 1996, courts were pretty slow to adopt it. So that was implemented more really kind of in the early 2000s, kind of between 2002 and 2007, but that process did start back in 1996. In 1997, they introduced kind of a national case search tool, the U.S. Party Case Index. So that way then people wanting to search about, trying to find, hey, was a case filed or things like that, could kind of search overall instead of having to search within each one of those 94 district courts. And then probably most importantly, in 1998, with the advent of the internet age, PACER first really became accessible via the internet, which really kind of increased, democratized the access to that. So what do we know about kind of prior litigation research? As I, briefly alluded to earlier, most of the extensive litigation research, all the research on litigation and disclosure and things like that are really motivated based on the fact that securities class actions impose substantial costs on firms, right? I mean, there are both monetary costs. So there are, of course, legal settlements, the cost of internal and external legal counsel, things like that. There's also a lot of non-monetary costs, right? So it could be a distraction, especially if senior management has to take a couple of days out of their normal job to sit for depositions or things like that. There are potentially reputational consequences, both to the corporation as a whole, to the directors, to the executives, things like that. And as a result, firms often have a lot of incentives to try to deter that litigation, and that's where a lot of the papers on litigation disclosure are motivated out of and things like that. We also know that because of those substantial costs, litigation filings trigger negative stock returns, right, on the filing date, just really reflecting kind of their economic significance, right? That investors really do think that if a company is sued, on average, its future discounted cash flows are lower, and its cost of equity capital is higher, and that's reflected in lower stock prices. And as I said, investors really rapidly seem to assess case merits. Years before these cases are actually settled, investors within days seem to identify pretty quickly that no, like these cases are really meritorious, maybe these other cases are really not, just suggesting really efficient information processing. And one possible way that they could do that is there is a lot of information. When you have a legal filing that is potentially 50 pages, 100 pages, 150 pages, there can be a lot of value-relevant information contained therein, which might be shaping these market reactions. That said, it's one thing to have this information in litigation filings. It's another thing to be able to understand it. Right, so we know from a long line of research that investors face a lot of just cognitive and information processing capabilities, right? I mean, we're talking about things like processing costs, limited attention, things like that. And we know that in other areas of the literature, complex, less readable disclosures lead to delayed market reactions. And these legal filings are written in really dense legalese, and we actually empirically confirm that in our paper. We actually look at firms' litigation filings compared to like the earnings announcements of these same firms, because a lot of the media coverage has kind of research is focused on earnings announcements, and unsurprisingly, we show that these legal filings have significantly less hard information. They're less specific. They've got more sentences. They've got longer sentences, more central causal embeddings. Like they're just empirically harder to read. And anecdotally, there's also a lot of evidence that non-lawyers just struggle to understand these things. So why might the media matter? Well, we know that the media can uncover and report on fraud. There have been a handful of papers that have looked at that. Obviously, not all litigation cases are, credible allegations of fraud. But if the media can kind of help and uncover and report on fraud, which are arguably the most complex and significant litigation cases, it certainly seems possible that they could have this ability to more widely report coherently on litigation. We do know that some reporters actually have litigation expertise. There are some reporters that actually did go to law school, have their JDs, or it's just really like that's part of their main beat, where they're just always reporting on these things. Of course, media coverage is broadly accessible, and so if the journalists in the financial press can really report on these things coherently, that seems like that information is going to be disseminated pretty widely and pretty cheaply to the average investors, and that could be a way it could be kind of incorporated into prices. Media also has some kind of privileged information sources, so we know that the media can relay information from parties to the litigation itself. So a lot of times plaintiffs' lawyers in particular may have incentives to kind of report this information to the press, both to try to kind of drum up support and kind of increase the size of their class in these securities class action cases. They may have access to others in judges' chambers, court reporters, things like that. And we do know from other areas of the literature as well that the media really can accelerate information incorporation into prices. Conversely, there are a lot of reasons why we may expect, especially in this setting, that the media may not matter. For the most part, prior research has shown that while the media can help incorporate information into prices, that's generally through information dissemination rather than information creation, right? And while information dissemination is obviously important, if these filings are really so complex and they're just kind of disseminating that complex information without kind of creating information to help contextualize or translate it, kind of raises the question, well, how helpful could that really be to the market, right, to really incorporate these things into prices? And while some reporters undoubtedly do have legal training, a lot of them don't. And we've all probably read articles in the press where that has been apparent, that these reporters did not necessarily have the knowledge on which to be reporting on the facts that they're reporting. Media also kind of has split incentives. So yes, the media does have some incentives to inform the market. The media also has incentives to entertain the market, right? Going back to Jensen 1979 and others. And if media coverage is going to be emphasizing kind of more sensational and legally irrelevant facts, not only may the media not help for kind of incorporating the relevant information into prices, it could actually hinder market efficiency, right? Because it could try to get investors focusing on things that really don't matter if you're trying to think about expected future discounted cash flows. And we also know from a lot of the existing media research that one of the reasons that the media is so important in kind of helping incorporate things in like earnings announcements is just because earnings announcements, there are just so many of them, right? And over such short periods of time, often because companies' calendar year ends often are kind of grouped together, that it's just investors are really just overwhelmed. But because litigation is relatively rare, because it is novel, it's going to stand out. Well, then maybe investors have kind of more capacity and motivation to just directly try to process them themselves. In which case, media coverage maybe doesn't really, it's less relevant in this setting. So our data sources. Oh, Helen, I see you raise your hand.
Yes, Am I allowed to ask questions
Yeah,
or?
absolutely. Please do.
Oh, okay. All right. I'm curious on your previous two slides. I mean, a lot of discussion is on the dissemination role, right? So I wonder,
Yes.
sometimes I think of situations where, they're just they read the filing more carefully and then they're able to understand it and summarize it. But then
Yep.
another point that you mentioned, I think the last or the third. Yeah, so I feel like there's another point is that maybe they have access to otherwise non-public
Yep.
proprietary information, right? So that they
Exactly.
can communicate that part to the market as well. So that's the second component. And then the third one you also mentioned when, whether or not they are able to actually generate new information, because on the filing date, I'm assuming right? The final outcome is quite uncertain, right? In terms of, settlement or the final legal liability. So I wonder if do you have any tests to, kind of differentiate all these three components? Maybe, I would hope that the first public dissemination role should be the most straightforward one. But I feel like, the dissemination of the otherwise proprietary information, that is kind of a very interesting. And then the third one is even more nuanced. So I was wondering,
Yes.
like, do you have something to kind of, tease out these three components?
We have things that are trying to do so, right? I mean,
Okay.
it's easier said than done.
Yeah,
And so,
definitely.
we can maybe kind of come back to this, and you can see if the things that we do are convince you or not. But yes, we've tried to do that. So kind of using the Blank Sport all 2020 paper on kind of the three types of investor processing costs. You've got kind of like awareness, acquisition, and integration. I think the integration is really the most interesting. And really this kind of information creation is definitely more interesting and more novel, because most prior research hasn't really shown can the media actually really kind of create new information that is otherwise not available, as opposed to just reporting these things and kind of raising awareness. I think if all we found was that the media just helped with information dissemination, I think that would be it's still important, but I think it's less interesting. But yes, and so there's going to be some features specifically of our design where we're trying to get at potentially the media, using this privileged, access. And we've actually talked to a former court reporter about how they did often have these connections with certain reporters, and they kind of give them a heads up about certain things. And we try to also look at the nature of the media articles themselves to try to get at, like if it's just information dissemination, a press release would be sufficient, right? But if it's really going to be more about helping translate and contextualize this information, you're going to need more substantive articles. And so we look at those as well to see if we find that.
Okay. A second question is that are there any disagreements or this is largely, they're bad news. Once we understand they're bad news, like everybody we're on the same page that they're bad news. Maybe for security litigation is less so, but I'm just trying to, to add a little bit extra layer in terms
Yeah.
of right, complex or do all the media coverage, do they disagree with each other in terms of the final consequence? And then does that or confuse the market a little bit? So that's
Yeah.
just my some sort of a comments when I see it through when I read your slides. Yeah.
Yeah, no, I appreciate that. That's a really good question. And actually, that's one thing we haven't really tried to look at is, we've looked at kind of the overlap between the content of, kind of the average media articles on the filing date and the filing itself to try to get a kind of, are they really reporting on what's in there? But we haven't actually really tried to look at kind of the convergence or lack thereof of media articles themselves, kind of like if you think about the analyst literature, kind of a analyst dispersion, some kind of media dispersion, and so that's I definitely would I'm honestly I'd have to think about that more. I mean the very fact of if you have a lot of information disagreement, right, that actually can result in a lot of trading, from like the opinion divergence literature and things like that. So if there are a lot of media articles that are saying different things, there's probably still going to be a big market reaction in terms of trading, but maybe you wouldn't see as much price impact because these things could kind of net out, which is one of the reasons too, when we look at market reactions, we look at both kind of a price-based measure and a trading-based measure. But that's definitely something that we can and should try to exploit a little more. So thank you for that.
All right, thank you.
So, our data sources are pretty standard for this. We obtain our litigation cases from the Stanford's Class Action Clearinghouse. We obtain information on litigation dockets, the timing of all these things from Audit Analytics and Court Listener, media coverage from Factiva, market data from CRISP, our intraday tests from Polygon, and financial statement data from CompuStat. So for our research design, where we kind of start, and then we're going to layer on some complexity here, but we started just kind of benchmarking off the Carrizosa and Kazir paper, since it's a really recent, well-done paper in the Accounting Review. And as part of that, what we're looking at is, our left-hand side variable, our measures of kind of market reaction are absolute stock returns and trading volume to just try to proxy for kind of the extent to which these litigation filings are really changing investors' opinions, and ultimately they're resulting in trades or price impact, since of course you could have one without the other and vice versa. As part of that test, we do allow for kind of partial anticipation because there's papers like the Gandy and Lewis 2009 JFQA paper that shows that investors can sometimes anticipate these things and delayed reactions. And we also do control for the class period end, which is when kind of the bad news comes out that ultimately triggers the litigation. Whether that's a restatement or a revision in management's forecast or something like that. We also know, of course, that the litigation environment, macroeconomic environment, right? All these things are changing over time, and so we include firm by year, quarter fixed effects to just try to control for all those things, hold those things constant, and make sure that they are not driving our results, right? And so this first test, which doesn't even include the media, but we just want to kind of a baseline thing to first kind of replicate prior literature and then kind of build from that. We basically confirm the inferences in the Carrizosa and Kazir paper. We use a slightly different time period. But what we show, and I've kind of isolated this with the kind of maroon box over that. If you focus on the return right around the filing date and shortly thereafter, you see that there is a big market reaction to litigation. And in columns 5 and 6, one concern is with litigation filings is that sometimes they can follow pretty quickly after the class period end when that bad news comes out. And we wanted to make sure that any kind of market reaction to the filings is actually a market reaction to the filings and not just kind of a delayed market reaction to that underlying bad news event. And so if we kind of exclude cases that are filed shortly thereafter, within basically 5 trading days of the class period end, we still find similar results. Actually, we find stronger results. And so first, just starting point, it is very clear that yes, there is a strong market reaction to litigation. So with that said, we got kind of interested, like I said, in, well, what might be the media's role in that? And just descriptively, I've got this both by year and overall. If you look at the bottom row, 73% of the time, companies have media coverage on the date of their filing, which really kind of raised the question to us. Some years it's as high as 90%. That it certainly seems like, well, maybe it's not just the filings themselves, but it seems like the media may have a really important role here, of being kind of an alternative access to this information. And the other thing that we did, as I mentioned, is we kind of realized that cases are actually posted in this online PACER system with a lag, a surprisingly large percentage of the time. Over our sample period, it's definitely gone down. It's lower in more recent years, but over our sample period, over a quarter of cases are posted, at least 2 days late. If over 15% are posted at least 3 days late, and so there's often this period of time whereby the company has been sued, but really absent media coverage or something else, the market may not know that the company has been sued, and so that kind of allows us to potentially try to. If we kind of focus in on that period, to potentially try to kind of isolate, to Helen's point, a period by which the media may be actually kind of effectively creating this information that's otherwise not public, potentially because of the private information that it does have. Now, with that, and so we then kind of modified our main design to incorporate that. But before we did that, we wanted to make sure that we really could kind of integrate this lag into our test, because we wanted to make sure, for example, that this lag itself is not effectively correlated with kind of the media's interest in the case itself, right? Because we know that market reactions are larger for meritorious cases, right, and things like that. And so we wanted to see if these lags themselves were relatively exogenous with respect to the media's interest itself, right? Because they're not really correlated with the firm or the case merits that much. And so we estimated this model where we looked at just the lag, the extent of this lag, both the existence of one as well as the length of one, the prominence of the firm, right, with assets, look at factors associated with the merits of the case, right? So does this thing involve accounting fraud allegations? Does this thing eventually settle? Things like that. And then just a lot of variables to try to control for, is this really just about kind of how busy the court clerks are themselves, right? So it's in a really busy district. There's got a lot of other cases going on. This is kind of before they had a high volume of electronic case records, things like that. And what we find is that we find no evidence that the merits of the case have anything to do with this lag, and very little evidence that the merits or the characteristics of the firms themselves have anything to do with this. But a lot of evidence that these lags are really just due to the fact that when clerks are busier, it takes longer for them to post. And so this gave us a little more comfort that it seems like this pacer lag really is kind of reasonably exogenous with respect to media interest. And so it can kind of allow us to try to kind of isolate this fact where we can kind of look at an effect of the media that is separate from an effect of the filing itself. And so when we kind of modified our test there, what we can show, and you can see in the kind of maroon box there, is when we're isolating on the period starting on the day of the filing through the period before it is actually publicly available in Pacer. So over this period of time, you still see a really strong reaction. This table is just using our absolute abnormal returns in column 1. But when we split that on media coverage in columns 2 and 3, you see that reaction is entirely due to the ones that have media coverage in that period. And we find similar results in columns 4 and 5 when we kind of drop these quick filings. Interestingly, we even kind of find that even once these things are located in Pacer, right? So anyone could go online the internet and download these filings themselves. As you can see in columns 2 and 4, we actually still find no effect for the cases that do not have this media coverage, even once they actually have the source documents available themselves. And so it seems really clear that media coverage seems really important here. This magnitude may seem a little small here, but of course, we're looking at all cases, both ones that settle and ones that are dismissed, but we're still talking about within fixed effect absolute abnormal return of about a 20% increase, right? So corresponds to about 4.1% or so. And if we just look at settled cases and untabulated tests, we find even larger reactions, right? And when we look at this using trading volume as our alternative measure of market attention, we find very similar inferences, right? With frankly even stronger magnitude. We're talking about cases that have media coverage. There's around a 33% increase in average daily trading. And so it certainly seems like media kind of matters a lot. Of course, that always does raise the question, though, of we know that media coverage is endogenous, right? So journalists potentially could be writing articles for the very cases and firms that might result in larger market reactions even without the media coverage, right? And so to try to mitigate those concerns, we first kind of did a determinants model just to say, okay, well, how does media coverage relate to the firms in our sample, where we've got a lot of variables of related to firm characteristics and firm prominence, the firm information environment, right? So things like analyst coverage and institutional environment, a lot of factors related to case merits, including most importantly potentially the actual damages. So how large those stock price drops are, just how significant these things are, busyness related to the factors. And then we take those determinants to try to create a match sample to kind of try to hold the cases that do receive media coverage constant with cases that do not, right? And whether we use a propensity score match sample, as in the table I've got right here, or an entropy balance sample, as you can see right here, we find basically the exact same results, right? So we find very large market reactions using trading volume or absolute abnormal returns for cases that receive media filing date coverage, and basically no reaction both during this kind of privileged window before it's publicly available, and even thereafter. Once it's available in Pacer, we still don't really find anything, right? Now, lastly, it does kind of raise the question, though, of, well, what if the media coverage is actually a response to the market reaction and not vice versa, right? So we've all probably seen articles before where, you know, even like the headline of the article is something like, oh, Tesla stock dropped 15% today, or something like that. And so we wanted to make sure that that wasn't the case, that, you know, this really was much more consistent with the fact that, like, the article is coming out and then media coverage, then prices move, right? Now, we had to do this with a smaller subsample of our test, just because our intraday trading data started in 2004 instead of 1998 when the rest of our sample starts. And of course, then we're restricted to cases that, you know, come out in articles that come out during you know, the period that the market is still active, and not after hours and things like that. So our confidence intervals are a little larger, but as you can kind of just see visually, before the first litigation-related article comes out, returns are basically flat, if not, you know, a little bit positive. But as you can see, almost immediately, you know, right in the center, right when this article comes out, you see prices drop, and they, you know, continue to kind of, you know, go down. And so it certainly seems like this is, once again, much more consistent with a story of, you know, more of a causal story of the coverage comes out and the markets react accordingly, right? So it seemed pretty clear to us at that point that the media really is critical for this market reaction. But it was still less clear, you know, well, why is that, right? So is this something about, you know, just information dissemination, or is this information creation, right? You know, is the media just trying to reduce kind of some of these investor processing costs, like it's like awareness, right? You know, it's just that the market wasn't aware that the company got sued, now it's aware. Or is it, you know, actually really helping reduce these integration processing costs, right? Really something that's actually really helping the market try to ascertain kind of what might be the expected litigation costs, so we can actually really more efficiently impound these effects into stock prices. And so the first thing we kind of looked at is, well, let's look at just the nature of the media coverage itself, okay? Because, so we look at first just press releases only, then we look at just kind of cases that have just kind of more what we'd call traditional media articles, and then cases where you have both. Because if this was just about information dissemination, if this was just about reducing kind of awareness processing costs, well, then it seems like press releases would be sufficient, right? Because the press release, investors can still know that the company has gotten sued, that information has been disseminated, and then they can do their own research and everything else and integrate that into prices. But what we find is that there's almost no reaction. You know, there's no price effects if you look in column 2, very little trading if you look in column 6 from press releases alone. But as you, you know, if you just go look at the magnitude of the estimated coefficient, if you look at columns 3 and 7, when we look at traditional media articles, and then if you look in columns 4 and 8, where we've got both, when you get a lot more information, well, that's going to be the exact type of information that you're going to really need to try to reduce these integration processing costs. And that's where we really find that you get these much larger market reactions, right? Now, given that we do find, you know, that it seems like the traditional media articles really are important here, we then went into to try to zero in a little more on these effect of, you know, kind of non-press release, you know, traditional media articles, to really say, look, if this is about the media informing the market, when there's a lot more, you know, relevant, specific information about the case and about the firm, that's where you're going to really get more of a reduction in these integration processing costs. That's where you should get larger effects. And so we kind of split on articles that were just about the sued firm versus, about maybe a lot of firms, right, in the industry, and then kind of the length of the article itself. And so, we require the article to be at least kind of 200 words to try to kind of drop out kind of these news flash articles and kind of more robo-journalism things that have been looked at in prior research. Because once again, those are going to be useful for maybe reducing awareness and acquisition processing costs, but they're not going to really help investors necessarily ascertain expected litigation costs. And what we find is that there's far less reaction when you have these shorter articles, but when you have these extensive filing date articles, that's where you see really large effects. And as you can see, kind of compared to the prior tables, the magnitude of these coefficients is much, much larger. We're talking about, 1.7% of daily absolute returns. So much larger market reactions, much more economic significance when these things are really detailed. And then we tried to focus even more on kind of, well, what's the similarity to the legal filing itself? Because kind of our contention is, if this is a story of, look, the litigation filings are hard to understand. Media articles are obviously much easier to understand. We also actually empirically confirm that in our sample, just, once again, looking at kind of those various linguistic measures, much easier to understand articles than, the filings themselves, unsurprisingly. Well, if the media is kind of helping translate this information, you should have kind of a higher overlap between the information that's included in the filing as in the articles themselves. But of course, it's going to be more understandable. And so we use kind of the traditional measures of kind of textual similarity, the cosine similarity measures, to try to kind of identify these media articles that have more case level information, albeit in more understandable ways. And we find, once again, significantly larger market reactions when these articles actually have more case relevant information. Once again, kind of consistent with the fact that these articles are not just telling companies and telling investors, hey, look, that these companies have been sued, but really telling them, here's why they've been sued, here's why this could matter. Right? Now, lastly, while the prior analyses kind of demonstrate that there definitely is this significant short-run market reaction to filing date media coverage, it's unclear whether that really is kind of consistent with this market efficiency story, right? That the media coverage is kind of increasing the speed by which litigation news is impounded into prices, or is this potentially some kind of overreaction, right? So the media is reporting on something, the market's reacting, but it really shouldn't be. And so eventually it's going to reverse, and really this story about kind of harming market efficiency. And so this is really important because it kind of informs on whether this media coverage is kind of a net good or bad, more long-term for the market. And so we kind of extend this out, 3 weeks. And as you can kind of see here, the orange line is the cases that have filing date media coverage. The dashed blue line are those that do not. And as you can see, obviously, there's this big drop immediately for the ones that have media coverage, and that kind of continues over the next few days, and then basically levels out. And eventually, about 3 weeks later, the cases that did not get filing date media coverage, the returns kind of converge there. And so we really see no evidence of any kind of reversal suggesting that this kind of filing date media coverage was irrational. But really, it just kind of seems like it's speeding up the extent to which that these prices are being recorded in, and reflected in prices by about 3 weeks in this case. And we extend this out even longer using like a full month, find similar results. Right. Now, while those are our main results, we do look at a lot of robustness and additional analyses. Our main tests use absolute returns for kind of assessing price impact, just kind of following prior research, and because we're just more focused on kind of does the market react as opposed to the sign of that. But of course, we do know that really the litigation market response should be negative for the most case. And so we use signed returns instead of absolute returns. In our tests, our main test initially, we just kind of say, hey, look, like, is there media coverage in Factiva, for these sued firms? But then we try to make sure, okay, well, is that media coverage, is it really about the litigation itself or just the firm? Because of course, some firms are just always in the news. So we kind of create a kind of a bag of words dictionary type approach with a bunch of litigation related keywords and just restrict our test to media coverage that have words in that dictionary. We say, okay, well, let's try to hold case merits a little more constant, right? I mean, we do that both in our match sample, but we say, okay, well, even kind of beyond that, let's do all of this just with the sample of cases that eventually settle. So even if we're only looking at cases that ex post are revealed to be meritorious, right? These things eventually settle. Do we find that the media is basically necessary and effectively required for some kind of market reaction? We also say, do these results change over time, right? So especially in kind of the second period of our sample, we know that this information is posted and pasted much quicker. Of course, this is now the kind of more the social media era, and so that could be another source potentially for case information. The litigation environment, the types of cases may have changed over time, and so we kind of separately estimate these results both from 1998 to 2008, and then from 2009 to 2019. We find similar inferences in all of those tests, right? And we tabulate all of those in our online appendix. And so it seems like our tests are pretty robust. To try to just shed a little more insight, we conduct a lot of additional analyses that we also report currently in our online appendix. So one thing that we look at, in our main tests, we're really focused on media coverage. But of course, you could argue that, look, the media is not the only kind of information producing market participant, and maybe even the media might act as a proxy for some of these other ones. And so we look at, the effect of other sophisticated market participants. Specifically, we look at equity analysts and kind of, some forecast revisions. We look at institutional ownership, and we look at short sellers. And what we find in those tests is we find that there is no significant association between analyst revisions or institutional ownership and the market reaction. And so it doesn't seem like those market participants really play any significant role in this reaction. We do find that companies that have higher short interest do have larger market reactions to litigation than companies that have lower short interest. Which could be consistent with short sellers potentially being helping kind of create some of this information and pound that into prices. But of course, we know that media coverage and short interest are not independent. And so we then kind of try to disentangle that by basically doing kind of a double independent sort where we're kind of sorting on high versus low short interest and media coverage versus not. And what we find is that really, this is all about, once again, the media coverage story. So if we look at cases where you've got high short interest and no media coverage, there's really no market reaction. And conversely, if we look at cases even where there's low short interest, but there is media coverage, you find significant market reaction. So once again, kind of validated our focus on the media and this really being about an important role of the media. We do actually try to exploit kind of that staggered case management, electronic case filing rollout, because if there are more once there were more electronic case filings, of course, it became much easier to actually not just be aware that a company got sued, but to actually be able to download those filings themselves. It really reduced this acquisition processing cost. And so to the extent that our results are kind of capturing, at least in part, just this acquisition processing cost story, right? That it's not so much that the media is helping investors understand what these filings are saying, but just that it's giving them access to this because otherwise they couldn't download it. We kind of exploit this kind of staggered diff and diff, and we find basically no change in our results pre and post the CM ECF rollout, suggesting that kind of information dissemination alone and kind of these acquisition processing costs really do seem to have very little effect on the market reactions in this setting. We also look at not just the existence of media coverage, but the volume of it, right? I mean, if you're kind of thinking about things like the Bradford Hill criterion and kind of the epidemiological research, kind of a dosage effect. If you have more coverage and these results are due to the coverage itself, you should see larger reactions. And indeed, that is what we find. We also do a number of other tests. We do things like partitioning on the media outlet prominence, right? Because not all media articles are created equally, and not all outlets are created equally, right? The Wall Street Journal, the New York Times, right? They probably have more sophistication, better quality reporters than maybe some smaller, more regional news outlet, things like that. We do find stronger results for the more major outlets, which are the ones that we would expect to be, more efficient for reducing these integration processing costs. We want to make sure that our results couldn't be due to hedge funds. Those seemed like maybe the one potential alternative market participant that might have enough economic incentives to try to, have, kind of monitor these district filings, district courts, to try to find some arbitrage opportunities. We kind of split on hedge fund cities versus non-hedge fund cities, and do find market reactions in each. And actually, the market reactions are smaller in hedge fund cities, so they're definitely not driving our results. And then we also tried to exploit the fact that, some firms, take firms like Tesla, Apple, right? Some of these firms are just really have a lot of high media prominence. They're just always in the news. And so we really wanted to try to more isolate, not just are these firms in the news, do they get filing date media coverage, but really do they get abnormal filing date media coverage, right? Like, is there a lot more articles that are talking about this firm, talking about the case, than we would just normally expect? And so we actually kind of create this measure where we look at the total number of articles around the filing itself and compare that and kind of difference that to the total number of articles over the exact same period a year before to get this more abnormal measure. And we then actually show that this abnormal filing date media coverage, it is predictive of case outcomes, both whether the case settles versus dismissed, as well as the settlement amount beyond standard merit factors. So even when we're already controlling for a lot of other factors that we know help predict these case outcomes. And so that further kind of gave us a little more comfort into kind of maybe this mechanism that, once again, it's that these media articles are ultimately helping investors better assess litigation costs and expected litigation costs. And that's why they can impound these things into stock prices more efficiently. So in conclusion, we find that, look, media coverage really seems largely, and not just important, but largely deterministic of whether there is a short-term market reaction to litigation or not. And we find that, kind of the totality of our results, we think that this is much more consistent with the media really providing information, really creating information that is reducing these investors' integration processing costs, as opposed to just an information dissemination story or something like that. It really does, we think, help kind of advance the media research, which is largely just kind of focused on, for the most part, media coverage around earnings announcements. So this kind of answers the call of the Blank Square All 2020 paper, really trying to better understand exactly how, why, and when the media really affects these processing costs beyond just kind of your traditional firm disclosures. And we think that our results potentially have at least some relevance to these ongoing actually policy discussions. So there are still a number of frictions to using the PACER system. There are actually like fees to download these things, and so there have been a lot of calls for reducing these fees or eliminating these fees, doing other things to just try to modernize the system, in part based on the fact that if we do this, it's going to make it much easier for investors and others to get and use these things. And while I would definitely love for my own research and everything else for some of these overhauls to happen to PACER, at least directly, it doesn't seem like that's going to really help investors directly, because it doesn't seem like investors are really using this information in PACER right now. Now, indirectly, maybe it could help investors if this is, would increase media research and reporting on these things, but it's more of an indirect story. And so conversely, we think there are a number of potential things that could actually maybe help increase media coverage, which our results then show would increase kind of the stock price efficiency. So for example, in the United States, there are still a lot of limits for various privacy concerns on like the use of cell phones in courtrooms and things like that. And a lot of reporters say that, look, that makes things just a lot harder to take notes or to timely report on these things, and so it's not worth my hassle. And so we think that potentially actually things more maybe simplistic reforms, like changing some of those policies just to try to make it more appealing and accessible for the media to report on cases, actually that could be maybe one of the best things you could do to just make the markets more aware and efficient with understanding what's going on with these cases. So with that said, that's all I've got, unless there are additional questions or comments. Thank you so much for your time on a Friday to listen to this.
Thank you very much, dear Professor Christopher Yust. Thank you very much for your effort and your excellent presentation. It's really an excellent presentation and excellent paper. Now, if anyone have any questions, you can open your mic and ask your question. If anyone have any questions, you can open your mic and ask your questions.
And if anyone thinks of anything after the fact too, or doesn't want to ask that, feel free to email me or things like that, and be happy to answer those questions offline.
Yes. Dear Professor, yes, I'm wondering if address indigeneity problems use exogenous shock as the newspaper strikes or reporter layoffs as an instrument for media coverage?
Yeah, we definitely could try to do something like that. There have been a few other papers, the Engelberg paper and the Journal of Finance, that have tried to use things like kind of labor issues or like weather issues, right? So if there's a snow day and the paper is shut down, how does that affect these things, to try to get at more of that causal effect? We think that the totality of our evidence, especially with our matching model and kind of trying to utilize that pacer delay, we think that we can still isolate, frankly, better than a lot of prior papers, the effect of the media coverage. But I think that there are definitely other things that we could do, whether as an instrument or whatever else, to just further try to rule out those concerns, right? I mean, that's the fundamental challenge of empirical research, is it's almost impossible to fully eliminate endogeneity concerns, but it's a question of can we sufficiently minimize those? And of course, there's some other tests we could try to do too, with things like the impact threshold for confounding effects, or the robustness of inference, to try to identify kind of how likely is it that some of these endogeneity factors or omitted variables could be driving our results. We have done some of that in further untabulated tests, and it seems like it would be very surprising for anything like that to be driving our results. But could it have some bearing? I mean, it's kind of impossible to rule that out, but it's a great suggestion.
Yeah, thank you. I wondering if it would be useful if small firm analysis. I wondering if we can compare market reactions for small versus large firms using matching samples.
Yeah, we definitely could. What's your thought? Is this just you're curious, or is there a concern that you have, so I can better know how to answer this?
Just to compare a small firm between the large firm.
Yeah, we could definitely do that. We haven't really done that right now, because one of the challenges is that we know that all things equal, large firms get a lot more media coverage. And so if you're comparing market reactions of large firms to small firms, you're also then, by definition, also kind of partitioning on media coverage in of itself. And so it's kind of harder to hold that constant. And so that's why we just right now kind of try to match on size to rule that out as something that's driving our results. I know in some untabulated results, we have looked just at small firms, and we have found that you definitely find these effects for small firms. I don't know if we've tried to compare the magnitude of that to large firms. I think maybe that further could have some policy implications, just because small firms, of course, have obviously less robust information environments. And so I think all things equal, you would probably expect the media coverage to actually be even more important for small firms, just because there's fewer alternative mechanisms for information dissemination. And so we would probably, I'm guessing we probably found even larger effects there, but I can't recall that off the fact. Thank you.
Thank you. The professor, other question about the economic significance of the result. Do you explain the economic significance of the result?
Yeah, I mean economic significance is one of those funny things where it's like you want it to be large enough that people say this matters and not too large that people believe it. We think that our main tests focus on kind of like all cases, not really generally differentiating based on whether they are settled versus dismissed. And of course, one of the challenges of that is we know from prior research that market reactions are much larger for cases that eventually settle versus ones that are dismissed. And so, like I said in the presentation, even when we're looking at all of them, if we're looking at kind of the multi-day kind of period around the filing, we're still talking about 3 to 4% abnormal returns, which isn't huge, but it definitely seems meaningful. If we focus on just like cases that eventually settle, so more meritorious ones, we're talking about the market reaction is an extra 5 to 6% over just a few days, which on an annualized basis would be pretty large. And so we think that seems reasonable, but also believable, and so we were pretty happy with it. I mean, it is what it is, for that. But that is one thing we've tried to kind of look at and try to quantify. And like I said, when we look at trading as well, we're finding that the kind of within fixed effect abnormal trading is 33% higher when the media coverage comes out, which once again seems pretty meaningful for that.
Yeah, thank you. What do you suggest for future research in this area?
I think that there's a number of working papers kind of in this space as well that I think are really doing some interesting research. I think that more people are moving away from just just looking at things like your traditional kind of crisp CompuStat results, and really trying to do more kind of linguistic analysis of things like the not just is there media coverage, but what are the contents of that? Not just are these cases sued, but what do the filings say? And so I think that the more I think kind of advances in textual analysis and potentially artificial intelligence and some of these things could be helping with that as well, to really just try to enriching our understanding of these things using textual analysis. I think could be interesting, just trying to better understand why these firms are sued, how the market identifies this, how it prices these things, especially given that these outcomes really are uncertain and don't get solidified until years in the future. What is in the filing themselves, things like this. I think that there's definitely a lot that we know, but I think that there's even more that we don't. And so I think it's a very exciting space to be researching.
Thank you. If anyone have any questions, you can open your mic and ask your question. If anyone have any questions, you can open your mic and ask your questions. Question about short seller media nexus, if it useful for as a mediation.
So is your question just talking more about that?
Yes.
Yeah.
Sure.
So here, this might actually help. So like I said, first when we just looked at the short interest, we tried to just do kind of a similar analysis to our media coverage, where we kind of split on, in this case, high versus low short interest. And we do see larger market reactions when there is higher short interest, which could be consistent with short sellers also helping kind of produce information, potentially through some of these, activist short seller reports on seeking alpha and things like that. But we do know from prior research that, short sellers and media are not independent, right? I mean, short sellers are both informed by the media and are influencing the media. And so we kind of did like I said, kind of effectively a two-way sort, whereby we tried to look at, okay, let's partition on high versus low short interest, and then with versus without media coverage within each one, both using our measures of absolute abnormal returns and using trading volume to try to kind of isolate, is it both of these things or is it really one versus the other? And what we find is that even in the high short interest, it seems like if there's no media coverage, you actually see like basically a significant underreaction or no reaction without media coverage. And conversely, even in the low short interest, so when there's very few short sellers that are involved in a firm, if you have media coverage, you see positive and significant market reactions. And so that gave us greater comfort that really, the fact that it seems like short interest is associated with this is really just because short interest is associated with media coverage, but really the story is all about the media coverage itself, which is why we focus the bulk of our tests on that.
Thank you very much. Thank you very much, Professor Christopher Reyes, for your contribution and your effort. It's really an excellent presentation. Thank you.
Thank you. Have a great day,
Thank you
everyone.
very much for thank you very much for taking the time to present to us today, Professor Christopher. Yes, it's have been appreciated.
Thank you.
And I hope to see you soon in Egypt. You are very, very welcome.
I hope so.